We have the core sector data with us, which is quite disappointing for the month of May. It's coming at around 2.8%. And remember, this compares to 8.5% that we saw in the previous month, which was in fact a 4-month high that we saw for the core sector data. This is the lowest level that we've seen for core sector data all the way back since December of 2015, where it had risen around just about 0.9%. We have to go through what exactly has led to the downtake, but cement output not as robust as what we saw in the previous month. So it's coming at around 2.4%. We have electricity also, which is slowed down as compared to the previous month. So that's coming at around 4.6%. But remember, it continues to grow. Otherwise, we have petroleum refinery, which is up around 1.2%. This compares to a 17.9% growth that we saw in the previous month. So you can fairly safely say that even though there have been growth figures which have come in, it is slower than what we saw in the previous month as well. To talk more about this, we have Aditi Nayar of ICRA, who is joining in to give her sense on the core sector data. Aditi, first, is there any sort of base impact which is played out for the May core sector data and your overall reading of it?
Thanks, Ekta. There certainly is a base effect. I mean, if we look at the data for April and May 2015, there was a minor contraction in April and then a modest 4.5% kind of growth in the month of May. So some slowdown from the 8.5% growth that we saw for the overall index in April was very much expected. We did think that the May core growth number would come in around 2 to 3%, so it's pretty much within that band. I think, particularly, for example, the drop in electricity growth is something that we already knew from the CEA data. That's, coming in because of a base effect. Similarly, for refinery products. So there are a number of items that are showing this dip in growth because of the base effect. I think what is possibly a source of some discomfort really is this further drop in cement growth that you already talked about.
Right.
So we had a really good Q4, and then after that we've had very sluggish prints in April and May. To some extent, this may be because, inventory had piled up after that very high growth in Q4. We'll have to see how things move going forward. But there is a silver lining as well, I think. I mean, if you look at the coal sector, we've had this fairly healthy turnaround to a 5.5% growth after the contraction in the last month. So perhaps some of the inventory-related issues for that sector are now behind us, and we'll get support from healthy growth from the coal sector going forward.
Okay, well, we've seen a decline, actually in natural gas this time, Aditi, continuing. So down 6.8% in the previous month, down 6.9% in this month. We've seen something like even steel, which has slowed down 6.1% 6.1% in the previous month, 3.2% in the month of May. Fertilizer has grown, so that I'll leave aside. We have cement, like you mentioned, which has slowed down compared to, say, the 12% that we saw in the month of Feb and 13%, 14% that we saw in the month of Jan, to around 4.4% in the month of April and now 2.4%. And electricity too, which has slowed down. So overall, barring cement, how would you classify the slower growth that we've seen in the other sectors? Base impact, inventory buildup, or just a general sluggishness which is creeping in?
I think it is a combination of these factors. Certainly, I would say electricity, refinery products, there is a base impact. Cement perhaps is an inventory impact. Coal is a positive turnaround. The steel sector, sure, it slowed down in terms of the 6% growth that we saw in April. But considering the fact that we've now got 3 months of positive number after several months of contraction, I think it's still, good news for that sector. It is reflecting the benefit from the imposition of the MRP. We'll have to see how long that lasts, whether it's beyond the scheduled date of August 2016 or not, and that will certainly have an impact on the outlook for growth for the steel sector.
Okay, well, your point is taken, in fact, on steel, because I just want to point out that in May of 2015, it had grown around 2.6%. And like you mentioned, it has been declining until Feb of 2016, where it was a decline of 0.5%. And since then, which is March, April, as well as this month's data, which is the May core sector data, we have seen it grew 3.4, 6.1, and then again 3.2%. So positive data which is coming in for the steel sector if you read it. Similar for fertilizer, which is up around 14.8% as compared to 7.8% going by this month's data. Aditi, how would you assume the IIP would pan out now? Because, we were just talking about a correlation the other day with regards to core sector and IIP. Do you think that there would be any correlation this time round with regards to what we're seeing in core sector and your assumption?
Yeah, no, I agree with you that the correlation between the performance of the core sector and the IIP has broken down to a large extent. I'll be surprised if we get growth for the IIP instead of a contraction, given this slowdown in the core sector growth.
Okay, fair enough. All right, Aditi, and your assumption in terms of how the core sector would in fact, tie in with all of the other high frequency indicators that we're seeing. We're getting the auto sales tomorrow, but we're just looking at a couple of high frequency indicators. We've seen credit growth pick up as compared to last year. We're seeing tractor growth, which is, up 20% as compared to a decline of around 18% in the previous year. So your sense in terms of whether the high frequency data is telling you something else as compared to the core sector?
So I think when we take all of these high-frequency indicators together, one obvious conclusion is that there is a fair bit of monthly volatility that we need to smooth out by maybe looking at 3-month moving averages. There is a very, a variable trend that many of the indicators are showing us when we look at the monthly data alone. So they don't quite continue to point in the same direction from one month to the next. But I think generally, if we smooth out these monthly fluctuations, there are a fair number of sectors that are showing an uptick. And I think now as we go forward over the next few months, with the positive impact of the monsoon and the pay commission, I think volume growth is set to show an improvement over a variety of sectors. And therefore, probably we're going to have a situation in 2016-17 where the GVA growth is not going to be so vastly different from what the volume-based indicators are telling us, the way that it was in 2015-16.
Okay, well, Aditi, we're not going to let you go so easily because we also have the April-May fiscal deficit data which has come out. For April-May together, the fiscal deficit data stands at 42.9% of the FY17 budgeted estimate. Remember that the FY17 budgeted estimate is around 5.3 lakh crore, and besides that, it's a target of around 3.5% of GDP. This compares to an April deficit figure of 1.37 lakh crore that we had done. So this time round, for both the months, it's coming at around 2.29 lakh crore totally. Aditi, your reading on it, it's generally data that, kind of fructifies or solidifies as the year progresses. So you won't read too much into this fiscal deficit data?
Absolutely. I think the numbers seem to be a little bit worse than what we had for April-May 2015, both for the fiscal deficit and the revenue deficit. But typically, the first quarter is really not a very good signal of how the rest of the year is going to pan out because of the very low base on which some of these growth rates and are available to us. So I wouldn't read too much into this data.
We're still waiting for more information to come in, but the assumption was that last month, there was higher expenditure because it was curtailed in the month of March in order to reach the fiscal deficit figure of 3.9% for FY16. Do you think that that's taken place as well, that expenditure which was curtailed in FY16 seems to be getting pushed out into FY17, into these 2 months specifically?
That's certainly a possibility. I mean, I haven't had a look at the numbers, so I don't know whether it's an issue of higher expenditure or lower revenue collections that's really led to this.
Okay, we're getting some more data, so I'm just going to fill you in on that. Net tax revenue, which is around 4.9% of the budgeted estimate. That's an additional piece of information that we're getting, Aditi, which is compared to 1.2% that we did in April. So that's improved.
Yeah, I think that is the case. It does seem that it's partly because of the expenditure side being higher. I think I'll just have to also take a look whether there is some impact because there were higher disinvestment inflows that had come in last year in April, May. If that's part of the puzzle as well, but No, perhaps not.
Yes, well, we have non-planned spending, which is 14.5% of the FY17 budgeted estimate. It's coming at around 2.07 lakh crore. And we have the total spending, which is also coming at around 15% of the FY17 estimated budget. So I assume that it is that incremental spending and lack of revenue which has resulted in the fiscal deficit figure that we're seeing. But do you think that's going to even out, or there might be a little
I actually think that part of the reason is that there were some upfront non-tax revenue receipts in April, May of last year. I think that's really what is skewing the data, perhaps not so much the tax or the expenditure side. Okay. And that perhaps is something that will even out as we go forward into the year. So like I said, I think, on a very small base, sometimes we tend to get spikes in or plunges in growth rates, in the early part of the fiscal year. So I think we need to wait for at least a quarter to go past and some advanced tax data coming in before we can really start to read the tea leaves for the rest of the fiscal year.
Okay, so you wouldn't be too perturbed by the fiscal deficit data, but you would be by the core data that we've got for the month of May.
So I think as far as the core sector data was concerned, we did expect it to drop down to around 3% or so. And that was particularly because we had this very sharp drop as far as electricity growth is concerned. Now, that is something that we don't think is going to necessarily sustain going forward. So we do think that, electricity growth is going to get better. One major reason for that is that, if we continue to assume that the monsoon is going to be above normal and that the reservoirs are going to get replenished, hydroelectricity generation, which has been dragging down electricity growth to a very large extent over the last couple of years, that is something that should revive, and that should really push up electricity growth quite substantially. And at least, the first round impact on the core sector growth will be there. Some trickle-down multiplier effect on the rest of the economy as well. Okay. So not really sure that May is going to be a very representative month as far as the core sector behavior is concerned.
Okay, fair enough, Aditi. We're going to let you go and enjoy your evening now. Thanks very much for joining in and giving us all of your perspective on the core sector data, which in fact has slowed down to 2.8% as compared to that elevated 8.5% that we saw in the previous month. But remember, there could be a base effect which could be in play here. 4.4% is what we had done in May of 2015. So maybe there could be that base impact which has come through. But you can't take away from the fact that there has been a slowdown in some sectors such as electricity, growing but slower than what we saw in previous months.
Ekta, a quick final question to you. Would there be some kind of an impact? The markets to an extent have shrugged off the kind of impact they used to see about 4 years ago from the core sector, but could there be some marginal impact specifically on sector-specific stocks?
Well, generally the core sector data always tends to have a little bit of a ripple effect on, cement stocks, etc., just based on the fact that it is growing or it's not growing. But I doubt, we've been brushing off everything, the Brexit. It seems as though the markets are in a mood of, just shrugging off any sort of information which is negative. But this is not really that negative, the core sector data. Yes, it's a slowdown, but it's not a negative territory. Yes, we've slowed down, but we're still growing for, I think, the 5th consecutive month in terms of core sector data.